So it is November. Wow, the election is over. And what's going on with the real estate market? What's the election doing to the real estate market? So far, nothing. And I don't think we're going to see any big changes, in the short term of what it is. With presidential elections, national policy, only if it really affects, capital gains, taxes, stuff like that, which could happen. That will affect the market. But day to day is really run much more locally. So let's see what's going on. We did see rates tick up a little bit. Let's see where things look like for the coming 2025. So Ralph McLaughlin, senior economist, Realtor.com, said the trajectory of rates over the coming months will be largely dependent on three key factors: the performance of the labor market, the outcome of the presidential election, and any possible reemergence of inflationary pressure. While volatility has been the theme of mortgage rates over the past several months, we expect stability to reemerge towards the end of November and into early December. So without a doubt, when, job market reports come out better than expected, rates go up. When the economy numbers overall are better, rates go up. Why? Because the Fed is probably not going to lower rates if the economy is doing strong, because they want to get that inflation number down to 2%. So inflation is still not quite where the Fed, wants it. Right now it's about 2.7. They want it at 2. Or just above. So I think there's still going to be, maybe a couple little things here or there that they're going to do to either talk about lowering the rates or lower the rates. But there's no mad rush to lower them because we're still at a higher inflation number than the Fed wants. So where do we think rates are going to be in 2025? I was talking to a couple different people. I think the majority of people are thinking it's still going to be in that 6.5% rate. Maybe get down to 6, by the end of 2025. For me personally, I think we're going to hit by the end of the year, if everything stays the way it is today, probably like a 5.75 by the end of 2025. I don't think we're going to see 5% for a while. I do think we got a few years from that. What does that do with prices? So the average between the 10 surveyed, economist companies is about 2.5% throughout the U.S. I think us locally will probably see a little bit more than that. I think we'll see anywhere from 2.5 to 5%. But you know what? 2.5 to 5%, that's a healthy growth. It's not bananas. It's not negative. It's a healthy growth. I like that. Ralph McLaughlin, again, senior economist, Realtor.com. There were 29.2% more homes actively for sale on a typical day in October compared with the same time in 2023, marking the 12th consecutive month of annual inventory growth and the highest count since December of 2019. We've seen a little bit more here. These are national numbers. All the parts of the country are definitely feeling the hit a little bit more. They are starting to see some price declines, seeing more inventory come on. I think for us locally, it still is very low. Like right now, the numbers are skewed where there's very low inventory, mostly because of time of year, and there's a lot more pending and sold because of time of year. So we're not seeing a huge influx now. Everybody's kind of anticipating the winter coming, even though we've had a really beautiful, beautiful fall. So we'll see what happens over the next few months, and the spring will kind of tell us a lot as far as inventory-wise. So the numbers are not, fully out yet, but what are the amount of home sales throughout the U.S.? So in the peak of 2021, 6.9 million home sales. Last year, 2023, we saw 4.8 million home sales, and we thought that was really going to be the bottom. Well, this year, at the current pace, it's only 4.6. So we're seeing lower amounts of inventory this year than we did last year throughout the U.S., and I think definitely in our case locally. So I think that's a big reason why we've seen these price increases. Projected for 2025 is 5.2. And you know what? Once again, we're starting, if we can get into that 5.2, 5.5 range, I think we're getting into a healthy balance of supply and demand. I don't think we see 5.5 for another 2 to 3 years, and we'll see some stabilization then. So the big question, is this the floor? Is this the basis of where prices are going to be? I think so. We could see, I think price increases, then maybe some declines from that point. But I think we're going to be pretty much, I would say, in this realm, 5 to 10% for the next few years, kind of in that standard deviation. One of the things to look at, consumer debt is at a record high. Mortgage rates are, the highest that they've been from the amount of money that's being borrowed. HELOC, auto loans, credit cards, student loans, and then other loans. But everything costs more today. So the question really is this relevant? Is this, equal to where the inflation numbers have been over the last 4 years? I'm going to say somewhat yes, somewhat no. Student loan debt is definitely increased, and I think that's something to be concerned about. Auto loans is higher than it was, but not dramatically. Credit card debt, same thing there. I think those are some of the three key factors, because you'll see, with mortgages, the other consumer side, I think that they can kind of, put a weight on the economy and what people want to spend. Historic equity means there won't be a crash. What's going on. So if you look at that last slide, we're seeing we have higher mortgage rates than ever. But the housing crisis, 2008, 2010, let's see, total housing mortgage value was 17.9 trillion. We had 9.7 in mortgage debt and 8.2 in homeowner equity. It was flipped. Right now, the value of the homes are 48.2 trillion, and we have 35.1 trillion in equity and 13.2 in mortgage debt. So as today's numbers, we're only 25% of mortgage debt, which is pretty good. Even if our values dropped 20%, we'd still be in a pretty good, situation there, because the mortgage debt wouldn't decrease, but the home equity would. So, once again, we've been in a pretty strong market. I think we're in a good place and where we need to be right now. We'll watch it. We'll see what happens, once the new president comes in. We'll see what rates do, and supply and demand. I think that's going to tell a lot. And, the weather, if we don't have a harsh winter, we're going to actually have an early spring market. If it's a bad winter, it may be delayed. So we'll watch and see what's going on. Any questions, definitely feel free to reach out. Happy to answer any questions you have.